There has been a lot of speculation about recession in the near future. Inflation has been running rampant. Credit markets are drying up as interest rates have been hiked to fight inflation. Even job growth is starting to show some softening from last year. But there is one thing outside of the Federal Reserve's control, and that one thing is keeping the U.S. economy strong, and that is Americans' wallets. Americans are doing one thing that they do best: buy lots of stuff. The U.S. Department of Commerce recently reported that June retail sales were up 0.2% from May, marking a third straight month of growth in consumer sales. Quarter 2 sales for 2023 are up 1.6% over quarter 2 sales from the year prior. As long as Americans continue to spend, the economy will likely remain strong. Personal consumption expenditures make up about 68% of the US gross domestic product, so consumption has sort of this oversized share in terms of strengthening the economy. American consumerism has deep roots. Production improvements in the 1920s allowed for goods to be mass-produced while dramatically cutting the costs of production. And the post-World War II economy took off in the 1950s on the back of American consumerism. Families started to move out to the suburbs. Production took off on durable goods and home appliances that were neglected during the war economy. Additionally, the US advertising machine kicked in and began marketing the value of being a consumer to Americans, and the rest is history. In fact, the American consumer was praised as a patriotic citizen in the 1950s, contributing to the ultimate success of the American way of life. Perhaps the most telling statistic is our global lead in household consumption expenditure per capita. America is the only country in the world topping $40,000 per person. It commands a 16% lead over its closest neighbor, Hong Kong, and as you'll note, the other countries that round out the top of the list have a population nowhere near the size of the United States' 330 million population estimate. It's not just goods either. There are many stories coming out about Americans buying more experiences and services too. We have seen Americans flock to Europe en masse this summer. Airfare to Europe has reached 6-year highs, averaging $1,200 a person, and hotel prices in Europe have seen surges of 37% according to Hopper. Looking at Taylor Swift mania, which has swept the country as she's embarked on her Eras tour, concert-starved fans in a post-pandemic world are opening their wallets like never before. Her concert is estimated to have sold 1.1 million tickets, and according to a survey conducted by Question Pro, they found that Swift concertgoers spent an average of $1,300 per show on expenses like tickets, outfits, travel, and food, which was an average of $720 higher than their intended budget. If those numbers in their sample are even remotely accurate, extrapolating that out shows us that Taylor Swift alone has created a $1.25 billion boom to the US economy. Even the Federal Reserve has noted how extraordinary Taylor Swift's impact on the economy has been. If you've found yourself consuming this video with enjoyment, then please give the video a like and consider subscribing to the channel for more business and economics content in the future. We could go on about the stories of American consumerism, but the question is, why does it matter? In theory, if people spend money, companies can keep employees in their jobs, and those workers then can also keep spending, which helps self-sustain the economy's momentum. The Federal Reserve has noted that they are actively looking at a couple of metrics for monitoring their interest rate hike policies, notably employment, GDP, and its subcomponent consumer spending are all key metrics. The Fed is still fighting inflation, and they have continued to hike interest rates. They will keep fighting that battle until they believe they have inflation under control. But their hope is that consumer spending will continue to buoy the economy, and they can achieve that fabled soft landing they continue to discuss. If consumer spending peels back, then it could create problems for the Fed. Their policies usually occur with a lag, meaning that if they stay on their fairly aggressive track for too long and consumers stop spending, then everything could come to a head all at once. So that begs the question, can consumer spending last? Well, the scary thing is, we don't know. During the pandemic, the American personal savings rate rose, and consumers amassed a large treasure trove of savings. Savings were estimated to be $2.3 trillion in 2020 and through the summer of 2021, according to Federal Reserve economists. That's about $2 trillion more than they would have saved under normal circumstances. Now, 2 years later, Americans are actually spending more than they normally would, using up their savings and taking on more debt. Economists know that the savings is dwindling, but they haven't figured out how much of that money is left. Even the Federal Reserve is offering conflicting accounts. In a recent report, the Federal Reserve Bank of San Francisco found that Americans still have excess savings of about $500 billion. It expects that money will last at least until the end of this year. Just a few weeks later, economists at the Federal Reserve Board of Governors in Washington said just the opposite. U.S. households had already gone through all of their excess savings, according to their research. Knowing when the U.S. consumer will run out of excess savings is an important piece of the puzzle. Remember that a higher Fed funds rate will begin to meaningfully slow down credit growth and hence consumer spending. Once consumers are out of excess money, consumer spending will likely do one of two things. First, be financed via credit cards. This could become problematic as borrowers will be faced with higher interest charges on their credit cards due to the Fed's interest rate hikes. We could see delinquencies rise over time and maybe see a delayed downturn in the economic cycle. Right now, delinquencies are pretty low and not a concern, but it's something to keep an eye on. Second, consumers will cut back on spending. If spending cuts happen, then our economy could see a slowdown a lot sooner than if it goes the financed route. All in all, consumer spending is a key metric that we need to keep monitoring going into the future. If you want to learn a bit more about how the economy and Wall Street are different, check out the video on the screen now. Thanks for watching, and I will see you in the next one.